Hey everyone, and welcome to this explainer. Look, today we are totally cracking the code on demand zone trading. Because let's be honest, if you've been relying on traditional support and resistance only to get stopped out time and time again, well, you are exactly in the right place. We are going to reveal exactly how retail traders can stop getting completely crushed by market makers and instead start riding the coattails of institutional giants. We're talking the big banks, hedge funds, the smart money.
But first, okay, let's address the elephant in the room. Have you ever experienced this? You're staring at your chart and the setup looks absolutely perfect. You buy at a clear, well-established support level, all your indicators are perfectly aligned, the trend is super obvious, and then boom. The market instantly crashes right through your stop loss, only to immediately reverse and go exactly in your predicted direction, without you. It's incredibly painful, but listen, you are definitely not alone in this.
Get this, 90%. An overwhelming 90% of traders are marking their supply and demand zones completely wrong. They are literally trading blind, relying on outdated methods that just end up trapping them on the wrong side of the market. The harsh reality is, if you can't spot high-quality institutional zones, your win rate is always going to suffer.
Okay, let's dive into this. Here is our roadmap for today's explainer. First, the retail trading trap. Then, the anatomy of demand zones. Next, drawing the perfect zone, followed by filtering high probability zones, and finally, trade entry and confirmation. We're going to give you the exact mechanics to trade alongside the smart money.
Section 1. The retail trading trap and the danger of inducements. So we have to expose this illusion of obvious early support levels. To really understand why you're constantly getting stopped out, you need to grasp the concept of an inducement. In a trending market, you'll often see multiple demand areas stacked up, right? And retail traders instinctively look at the highest, most convenient level, the one closest to the current price. It just looks like an easy entry. But institutions know this. They intentionally create this fake zone to trick retail traders into entering early. Why? Because when retail traders buy, where do they put their stop losses? Just below that level. That creates a massive pool of sell orders or liquidity just sitting there waiting to be swept.
And this brilliantly illustrates the whole David versus Goliath dynamic playing out on your charts every single day. Retail logic dictates buying at that early, obvious support. But smart money logic? It's entirely different. Institutions deal in billions of dollars. They can't just click a buy button. If they want to enter massive long positions, they actually need an equal amount of sell orders to match against. So what do? They push the price down, trigger those retail stop losses, sweep up all that liquidity, and use it to fill their massive orders right before reversing the market upward. It's totally ruthless, but it's how the game is played.
All right, moving on to Section 2, Anatomy of Demand Zones, the footprints of giants.
So how do we actually avoid this trap? Well, we have to stop looking for obvious support and start looking for undeniable footprints. The big players, they literally cannot hide their size. When they enter the market, it creates a sudden, massive imbalance between buyers and sellers. It is not a slow, drifting price movement. It's an explosion. It's aggressive momentum that violently breaks the market out of a resting phase, leaving these large, full-bodied momentum candles in its wake. Those small, choppy candles, that's just retail noise. True demand zones are born from sheer institutional aggression.
And when price rockets upward like that, it leaves behind something absolutely crucial. A fair value gap, also known as an imbalance. Because the price moves so impulsively, there was no proper trading between buyers and sellers in that space. It just creates this empty gap on the chart. And here is the secret. That empty space acts like a giant magnet. The market hates inefficiency. It will almost always try to pull the price back down to fill that gap and rebalance the market before it continues its upward trend.
Let's move to Section 3 and see how this builds, drawing the perfect zone from wick to wick. Okay, let's get practical and make this mechanical. How do you actually find and draw these areas? It basically boils down to a super simple three-step process. First, you want to scan your chart for at least 3 consecutive momentum candles. We're talking big, bold candles showing really aggressive buying. Second, look back to the exact origin of that move. Find the last opposite candle right before the explosion. So, in a bullish scenario, this is the last red or bearish candle. Finally, grab your rectangle tool and draw a box around that entire origin candle, from the very top of its wick to the very bottom of its wick. Drag that box to the right, and boom, congratulations, you've just mapped a high-probability institutional demand zone.
Now, what's really interesting about this is that there isn't just one single way to draw a zone. It actually depends entirely on your personal risk tolerance. You have the range zone, which uses that entire origin candle we just talked about. That gives you a wider stop loss, but a much higher chance of actually getting tagged into the trade. Then you've got the pivot zone, which is a bit more refined. And finally, the fractal or wick zone. This is where you only draw your box around the long wick of the origin candle. It offers maximum precision and a crazy tight stop loss for massive risk-to-reward ratios. But the trade-off is you might actually miss entries if the price doesn't dip quite deep enough into your zone. You just have to pick the style that matches your own psychology.
All right, Section 4, Filtering High Probability Zones, the Golden Rules. Listen carefully to this part because not all zones are created equal. In fact, some of them are completely useless. We need really strict filters to separate the fakeouts from the true market movers. So here are the 4 foundational pillars of a valid zone. First, it must break market structure. If a zone pushes price up but completely fails to break the previous high, it's weak. It just means the institutions weren't really throwing their weight behind it. Second, it absolutely must have strong momentum and leave an imbalance, exactly like we just discussed. Third, it should ideally sweep liquidity first, meaning it dips below a previous low to trap those retail traders before rocketing up. And fourth, it has to be a fresh, untested zone.
I want you to pay really close attention to this principle. Time spent equals strength revealed. If you're looking at a base and the price barely even pauses there before launching out, that is a massive clue. On a chart, hesitation is weakness. A sudden explosive departure means that huge institutional orders hit that market at lightning speed. Basically, the less time price spends in a zone before breaking out, the stronger that zone is going to be when the price eventually makes its way back to it.
Which brings us to Section 5, Trade Entry and Confirmation, Striking with Precision.
Okay, so we found the footprints. Now, how do we actually catch the ride without getting faked out? Remember, institutions scale into positions in phases. They don't usually get all their orders filled on that very first explosive move. So, step 1, patiently wait for the price to return or mitigate the zone. Do not chase the breakout, just wait. Step 2, once price finally taps your zone, you zoom into a lower time frame and look for confirmation. You want to see a solid rejection, maybe a long wick doji or a strong bullish engulfing candle. That proves the big boys are stepping back in to defend their territory. And step 3, this is a brilliant pro tip. Add Fibonacci confluence. If you pull a Fibonacci retracement and that 61.8% golden level lines up perfectly with your demand zone, your probability of success just skyrocket.
So, the absolutely crucial point to remember here is this. A fresh zone, untouched by price, holds the strongest institutional orders. Think of it this way. Every single time the price taps a zone, it acts like a sponge, just draining away the remaining institutional buy orders. That first tap, that is your safest, most explosive opportunity. By the second or third tap, that zone is completely exhausted, and price is highly likely to just break right through it. You've got to stay focused on the fresh zones.
By mastering these concepts, identifying those tricky inducements, locating massive imbalances, drawing really precise wick-to-wick zones, and just patiently waiting for that lower time frame confirmation, you completely flip the script. You're no longer the liquidity being swept, you are the trader riding the institutional wave. So I guess the only question left to ask is, are you ready to stop trading against the institutions and start trading with them? Thanks so much for joining me on this explainer, and I'll catch you on the next one.
This image is for illustrative purposes only. To gain a deeper and more structured understanding, join my community, where you will have access to comprehensive materials and detailed guidance.